The first trade happens before the news is born, not before it is published, not before it trends on social media, not even before journalists start writing it, before it exists as a fact in the public world. The market has already moved, and by the time you hear the explanation, the money has already finished reacting. That's the part most people never really feel, because from the outside it still looks simple. Something happens in the world, a headline comes out, markets react. But inside the system, it doesn't work that way anymore. It works in reverse. Price moves first, story comes later. And the gap between those two moments is where modern finance actually lives. Let's go into a quiet moment. It's 2:17 a.m. in New York. Most people are asleep. Phones on silent. Cities paused. But inside servers scattered across financial districts and data centers, something is fully awake. Not humans, machines. They are not thinking in sentences. They are calculating probabilities, thousands of inputs per second, shipping delays, bond spreads, credit card flows, energy consumption, factory output signals, satellite images of parking lots, even how often delivery trucks enter warehouses. Each one is meaningless alone, but together they form a shadow version of the economy. A version that updates before humans can even describe what is happening. And that shadow economy is what moves prices. Not news, not headlines, shadow signals. Now here's the uncomfortable shift. Most people believe markets respond to information. That idea is outdated. Markets don't respond to information anymore. They respond to expectations of information, and more importantly, they respond to changes in those expectations. Not truth, not facts. Just deviation. Let's slow this down with something simple. Imagine a company is going to report earnings next week. You think the market will react when the report is released. But in reality, the reaction begins days earlier, because large funds are already tracking everything around that company. Not just revenue estimates, but behavior. Are customers spending more or less? Are suppliers shipping on time? Are employees leaving quietly? Are web searches rising or falling? Is warehouse activity increasing or slowing? None of these are official, but together they form a probability curve, and that curve starts shifting long before earnings are announced. Now here's the key idea. Markets don't wait for certainty. They trade on probability updates, and once enough probability shifts in one direction, price has to adjust. Because price is not a reflection of truth. It is a reflection of collective positioning under uncertainty. So, by the time the earnings report is released, the market has already been living inside versions of that report for days. If reality matches expectation, nothing dramatic happens. If reality slightly surprises, price adjusts instantly. And if reality contradicts expectation, that's when you see sharp moves. Not because something new happened, but because something expected failed to happen. Now let's go deeper into something most people never think about. Why is speed so important? In traditional thinking, speed is about reacting faster. But in modern financial systems, speed is about reacting before the reaction becomes obvious. There are trading systems today that don't wait for news at all. They consume raw data streams, and not even human-readable data. Machine-readable fragments of reality. Then they process it in milliseconds and convert it into positioning before any explanation exists. Think about that carefully. A system sees a pattern forming in shipping data. It doesn't know what it means, but it knows similar patterns in the past often preceded lower earnings, so it acts. It doesn't wait for confirmation, because confirmation is too slow. By the time confirmation arrives, the opportunity is gone. And here's where something almost strange happens. The market begins to predict itself, because once enough participants are reacting to the same signals, their reactions become signals for others. It becomes reflex layered on reflex, anticipation stacked on anticipation, and eventually price starts moving not because of reality, but because of how reality is expected to be interpreted. This is where financial markets become psychological systems, not just economic ones. Because everything depends on expectation, And expectation depends on perception, and perception is shaped by incomplete data. Now let's contrast two worlds. In the public world, news works like this: event, investigation, article, headline, reaction. But in markets, it often works like this: signals, probability shift, price movement, headline, explanation. The story is always last, not first. And this creates a strange illusion. It feels like news is causing movement. But in many cases, news is just catching up to movement, explaining something already priced in. And this is why financial news often feels slightly late, even when it is breaking, because it is not breaking anything. It is translating something that already broke internally. Now let's talk about something more uncomfortable. Information is not distributed equally in time. Some participants see signals earlier, others see them later. And that time gap is not random. It is structured. It is built into the system. Because access to faster, cleaner, more granular data costs money. A lot of money. So what actually separates participants is not intelligence alone. It is timing, and timing is power. Now think about what that means. If you see a shift in demand today, and others see it tomorrow, you don't just have information advantage, you have pricing advantage, because price hasn't adjusted yet. And once price adjusts, that advantage disappears. So modern finance becomes a race not for truth, but for early interpretation of incomplete truth. And whoever is slightly earlier wins disproportionately. Now here's where things become even more subtle. In the past, markets were driven by events: war, policy, earnings, crashes. But now markets are increasingly driven by continuous data flow. There is no start or end anymore, just constant adjustment. A living system reacting to itself. And in that system, news is no longer the trigger. It is the echo. Let's step back. Why does this feel strange to most people? Because human thinking is narrative-based. We understand the world through stories. Something happens, then we explain it. Cause, effect. But markets do not operate narratively. They operate probabilistically. Effect often comes before explanation, and cause is reconstructed afterward. That's why financial explanations often feel satisfying but slightly incomplete. Because they are post-rationalizations, they explain movement after the fact, not before it. Now let's go into the hidden mechanism behind all of this. At the core, markets are built on one idea. Future expectations are more important than present reality. Not what is happening, but what people think will happen. And not even what they think, but what they think others think will happen. It becomes recursive, a loop of anticipation. And in that loop, small changes matter more than big events. A slight downgrade in guidance, a tiny shift in language from a CEO, a marginal change in inflation expectation. These small signals move capital, because capital is constantly repositioning itself for what might come next. Now zoom out even further. Imagine the entire global financial system as a massive prediction engine. Every participant is not just reacting to the world. They are trying to guess how everyone else will react to the world. And that creates a system where movement often happens before clarity. So when you finally hear a news story like markets fall due to economic concerns, what it really means is markets had already been adjusting for those concerns long before anyone wrote the sentence. The sentence is just the label placed on the aftermath. Now, let's bring this to a human level, because this system creates a quiet disconnect. People think they are reacting to reality, but in finance, they are often reacting to adjusted expectations of reality that were formed earlier by someone else reacting faster. And that chain never really stops. It just keeps moving backward in time. And this is where the irony becomes sharp. The more advanced the system becomes, the less useful simple explanations become. Because explanations arrive too late, and by the time they arrive, the system has already moved on. Now we are getting close to the core truth. Why do financial markets move before news reaches the public? Because news is not the origin of information. It is the final compression of thousands of earlier signals. It is the last visible layer of something that started much earlier in invisible form. By the time something becomes official news, it has already been observed in fragments modeled in probabilities traded in positioning and priced into reality. The headline is just the translation, not the trigger. And now we arrive at the final uncomfortable realization. If price already reflects what is likely to be true, then what is the purpose of the news we receive after? Is it information, or is it simply confirmation of something already decided elsewhere? Because in modern financial systems, the real action is not in headlines. It is in anticipation, and anticipation does not wait for permission. It moves first, explains later, and leaves the rest of us reading the story after the ending has already been written in price. So, next time you see a financial headline that feels urgent, pause for a second and ask a different question. Not what happened, but how long ago did the system already start reacting to this? Because in the world of modern markets, news doesn't move prices. It arrives after them. And the real story is never in the headline. It is in everything that happened before the headline existed at all.